You're watching us here on Chartbusters. The first hour looks rather wobbly. We had seen a positive open. Thereafter, there was a bit of a decline. And then now the market, is stabilizing around that 17,700 mark itself. There's, the low point of the trade for the index. There is weakness. There is some volatility in sentiment, though the mid-cap index is doing well. I'm Mangla Malu. With me, as always, Nigel D'Souza. But we do have a fair amount of earnings on our radar today. Quest Corp is the stock which is in focus as the company's posted a subdued set in the third quarter. Revenue growth has slowed down to 21% from the 33% that we saw in the last quarter. They've also seen margin contraction owing to increased investment, salary hikes on rising spend on travel. We have with us Kamal Palhoda, who is the CFO of the company, joining in. Thanks a lot, Kamal, for joining in. And that really is, what we'd like to understand from you. Can you talk about the impact of IT slowdown, slowdown in IT hiring, because your overall headcount is up just 20% as against 26% earlier. Revenue growth too has slowed down into 20s versus 33% earlier.
Good morning, Manglam, and thank you for having me. And yes, you're right. I seems to be having a subdued demand right now, and the business environment for the quarter was muted across all sectors. Seven except, there were some big wins in BFSI and manufacturing, and these two sectors continue to grow. These two sectors also have a very good positive outlook for the upcoming year, especially with the announcement of significant investments that the government has committed in manufacturing, which also leads to additional credit with the banking sector. And these two sectors, we are pretty hopeful that will continue to, grow and expand for us in next subsequent year.
Okay, so could you give us some kind of guidance then in terms of what kind of growth should we be looking at going ahead? And also give us a sense about how was festive hiring? We had team leads who had joined in and they said that it was a little bit weaker. Your sense?
Sure. So let me answer. In terms of guidance, see, the current year, despite, the muting which was there across all sectors, our revenue grew 21%. On a year-on-year basis and 4% on a quarter-on-quarter basis. The EBITDA also grew 8% on a quarter-on-quarter basis. So I think we've done reasonably well, especially the kind of environment which is there externally. As far as your question on demand is concerned, we saw a peak demand going up to almost 36,000 open positions, and that was in the month of September and October pre-Diwali, which happens. It was at its peak in that month. Now, typically, Diwali this time again being preponed in the October and not being in November, the headcount came down significantly in November and December. Having said that, on a quarter-on-quarter basis, we were able to maintain a flat headcount. And the sectors that help us, which I already called out, were BFSI and manufacturing as far as general staffing is concerned. In our OEM platform also, we added 4% headcount on a quarter-on-quarter basis.
So can you give us some more numbers, Kamal? In the fourth quarter, should we expect headcounts to reduce from the 26-27% that we've seen and lower than the 20% that we saw in the third quarter as well? Or will they claw back to the 20% plus? What's a sustainable rate out there? That's point number one. And secondly, on margins, when the costs were lower as people weren't moving around as much, you hit margins closer to 5% as well. But over the last few quarters, we've seen your margins decline. You're trying to address this by, hiring consultants, by reducing your SG&A, sales and general administration expenses by about 50 basis points. So what sort of margin band should we work with and what sort of headcount growth should we expect?
Sure. So to your question specifically on quarter four, we believe this, muted growth which is there will continue, especially on the IT and ITS side. And definitely manufacturing and BFSI, we expect the growth momentum will continue, which should put Quest probably, exiting again at a 20% growth on a year-on-year basis as far as quarter four is concerned. On our cost and EBITDA margins, I think you picked it up right that, the addressable areas of cost we are working upon. So we are trying to bring down our SG&A cost. And in terms of margin contraction, I think one big call out there from a year-on-year basis is the investments that we are doing in our product-led platform. In Founded, earlier formerly known as Monster. So we've rebranded and we are converting this into, from a job portal to, an entire end-to-end talent management platform. This year, on a year-on-year basis, we expect at least a 90 crores of an additional investment vis-a-vis last year. which is also one of the primary reasons if you see our consolidated margins coming down. Now, on that particular platform, we expect Founded to actually do break even by the Q4 of next financial year, which is where we would see margins coming back to the levels that we used to do earlier. Additionally, there's a lot of work internally being done in terms of right sizing our cost base, which is also shown some improvement in our margin by 10 basis points on a quarter-on-quarter basis.
How much more is pending with the strategic engagement with BCG? I mean, could you give us a sense? What's the mandate given to them? What's the target? Do you have a ballpark number there?
Sure. So see, BCG is a strategic engagement. It's not just around cost. It is around multiple areas. It's around also, helping us, work on qualitative growth. And it's a assignment, spanning over Q4 of this year and Q1 of next year. We'll love to share more around this assignment after we've done some significant amount of work along with BCG.
Okay, all right. Thanks so much for stopping by and giving us all those details. Wishing you a good quarter ahead. We look forward to touching base and getting a quick update. Hopefully, business recovers well as well. Well, that's management of Quest Corp. But for the time being, we'll shift focus to our special segment where we get you a few ideas for profit from Money Control Pro. Nitin Sharma, moneycontrol.com, joins us to talk about a stock that he's tracking rather closely. Nitin?
Recently reported MapMyIndia's third quarter result was good both in terms of revenue growth as well as the margin improvement. Year-on-year revenue growth of 56% was led by the automotive and mobility segment, which jumped 45% over the last year and was significantly above the passenger vehicle production growth of 30%, the underlying client that uses navigation tools. While for the consumer tech division, this was a seasonally weak quarter. However, it also posted an YOY revenue growth of 76%. Company's EBITDA margin improved to 41.2%, aided by lower marketing spend as well as the top line growth. Company continues to invest in its IoT solutions that require it to sell devices on low margin, but gave triple-digit YOY revenue growth, and from the second year onwards helped company earn 35 to 40% margin through SaaS business. MapMyIndia is seeing acceleration in revenue growth while maintaining EBITDA margin within the 40 to 45% range, which is excellent. On the valuation side, stock has corrected in the last 3 months. However, its rapid growth and strong margin in a large addressable market set it apart from the other tech businesses and hence justifies premium valuation. Stock is trading at a FY24 P of 39 times. Investors should use correction to build a position in the stock.
Thanks a lot for that, Nitin. For the time being, we'll slip into a short break. Up next, we'll be joined by the Chief Financial Officer of Birla Corp. Welcome back. Well, the Nifty is down 130 points, but what's heartening today is the mid-cap index continues to trade in the green with a gain of close to around 0.5%. In a couple of those stocks, well, they're looking quite good. AMI Organics, remember the stock has seen a sharp correction from the recent peak. But as we speak, it's still holding with a gain of close to around 2%. There was some bit of margin improvement that we saw on a sequential basis. It seems the street likes that, so that's holding in the green. You also have Religare, which has seen a correction from the recent peak, but that stock as well has seen a bit of a recovery intraday. I think the last 30 minutes or so, the stock has moved from the red to the green terrain currently at the high point of the day. But let's focus on the cement space. Birla Corp, well, they posted numbers which are a little lower than what the street was working with. Valuation-wise, though, there's a lot of comfort that comes in there. So let's welcome Ms. Aditya Sarogi, the Chief Financial Officer of the company, who joins us. Hi, Mr. Sarogi. Thanks so much for joining in. Well, let's get the volume picture first out of the way, since you have had capacities coming on stream, both at Mukutband as well as at Chanderia. What kind of a volume growth are you looking at for this year? Earlier, you were talking about 15%. And for FY24, since both the plants will stabilize, what kind of a volume growth are you looking at?
See, in Q4, in Q3, we had a double-digit growth. In Q4 also, we expect to maintain a double-digit growth.
Okay. And you'll end the year with 15% volume growth?
We might fall a bit short of 15%.
Okay.
But we'll definitely have a double-digit growth.
Double. So now,
so
now you're guiding for a number of close to around 10 to around 12%?
It should be 12 to 13%.
12 to 13% versus 15% earlier. Got that. And what about for the coming year, FY24? Given that demand is strong, that's what reports indicate. Do you believe that in the coming year as well, you can do more than double-digit growth?
The coming year also will do a double-digit growth for sure. but in terms of more precise numbers, I'll be able to give a sense in the next quarter.
All right, Mrs. Raugi, always a pleasure speaking with you. Now that you've spoken about volumes, etc., let's talk a little about your operational performance as well. What kind of EBITDA per ton can you guide for in the fourth quarter? And Nigel was alluding to a couple of facilities as well. Mukutban is the one that I want to talk about. Has it turned EBITDA positive? By when does it break even?
See, coming to EBITDA, if you see sequentially, we have been doing better. We have been posting better EBITDA, and we expect to maintain that trend. So sequentially, we should be doing better in terms of EBITDA per ton. I would not like to give an exact number, but the trend is definitely positive.
Okay.
And coming to break-even of Mukutban, that we expect to happen in the next year. Because we have got the costs under control now with all the facilities under operation. The waste heat recovery also is under operation in this quarter.
Okay.
So with all the levers in place, next year we expect the incentive also to trigger in, which itself will have an impact of more than 600 rupees a ton.
The incentives will help by 600 rupees per ton. Okay, so quarter one FY24 is when Mukutban breaks even?
It may not be in quarter one because the incentive will kick in a bit later because we first need to exhaust our input tax credit.
Okay. So in the first half of the year, should we assume that you break even?
Second half is more likely.
Second half of the year, Mukutban will break even, and the losses over there have been coming down, so that's as well heartening. Now, your EBITDA per ton, sir, including Mukutban, well, that's improved to around 380 rupees from around 230 rupees. And excluding Mukutban, you're nearly at around 500 rupees. Could you tell us what is the outlook? How much can it improve, say, in quarter four and from here on? Do you get back to 600, 650 rupees in the next couple of quarters? What is your guidance on EBITDA per ton?
See, it largely depends on the market, which has frankly not been supportive, not only for us, but for the entire industry. Typically, in the third and the fourth quarter, you expect price hikes, which have not really happened. So, if we don't get any price hike, it will be difficult to get to the figure of 600, 650, which was what we were expecting earlier. But definitely, given the cost pressures have come off quite a bit, we expect the cost to come down, and that should help us increase the EBITDA on a sequential basis.
So, if the price stay where they are and there is no change, what kind of EBITDA per ton can you look at?
I would say at least 50 to 100 rupees, if not more.
50 to 100 rupees improvement from here. So that's so it should be in the vicinity of around 450 to 500 rupees.
Yes, that's what I would expect at this point of time.
Okay, 450 to 500 rupees, and
if we get any benefit on the pricing front, that could be higher also.
Right.
Okay.
And on the debt front, what is the exact debt right now that you have, and what are the debt reduction plans for FY24?
We have about 4,100 crores of net debt. We have had a peak last quarter itself. Since then, it's been coming down, and on a continuous basis, we expect it to come down. We've already had a peak in the second quarter of this financial year.
By how much?
In terms of
go ahead.
In terms of debt reduction, what we are doing, we are currently focusing on consolidation of our operations, ramping up our Mukutban plant.
Yeah.
So once that facility starts generating cash flow, we will use that for repayment of our debt, and we should come down on a gradual basis.
So by the end of FY24, debt could come down by 10%. Is that possible from 4,100 crores?
Maybe next quarter I'll be in a better position to give.
Okay, as of now, you can't commit on that front. Very quickly, your press release talks a lot about captive coal. And you're going to be ramping up your blocks. Could you tell us what is the ideal mix in FY24, say, out of your total coal requirement, how much will come in captively?
Between 37 to 40% should be coming from not exactly next year, because we are going to start it somewhere in the Q2. But once it is fully operational, that will cater to about 38 to 40% of our total fuel requirement.
That will be in 2025, I'm guessing.
Yeah, next year from Q3 we'll start getting benefit of that.
Okay, and 38 to 40% in FY25.
Yeah.
Okay, all right. Thanks so much for stopping by, Mr. Sirogi, and filling us in with all those details, sounding a little bit optimistic that things will improve from here on. But pricing doesn't move up, and that is a bit of a worry. Well, time to slip into a short break. As we do that, here's some exciting news. The most coveted leadership awards are back. CNBC-TV18 honors the visionaries behind outstanding businesses. Cast the most influential, credible, powerful IBLA jury on February 8th, right here on CNBC-TV18.
Incremental weakness continues for the market. The Nifty Bank is now down 200 points, led lower by HDFC Bank and ICICI Bank, both of them respectively at the low point of trade. The mid-cap index, while at an index level, is doing well. We do have a couple of stocks which are actually selling off, and most of them actually belong to the footwear end of things. You have Relaxo Footwear, which has moved to the low point of trade. Remember, the stock has already corrected about 41% from the highs, but now is lower because of the poor performance that the company reported in their third quarter numbers, as a result of which we are seeing some sell-off in Campus Activewear as well as Bata as well. Both of them currently at the low point of trade. Remember, despite a 40% correction from the top, the stock in terms of a market cap is still higher than its other peers, for instance, Bata as well as Campus Activewear too. So we'll see what happens with Relaxo going forward. And we're seeing the sell-off in VIP as well. That is a bit uncharacteristic because from the highs, the stock is corrected about 4% odd. No problems with the numbers. In fact, their numbers were a record high this time around. We saw a big move on the stock as well. So let's see where this one goes on, high volumes. VIP is lower by about 4%. So these are a bunch of stocks we're watching out for. By and large, weakness continues for the market. Adani Group stocks is something we'll be watching out for. Chartbusters wraps up right now. Take a short break, come back. Trading hour continues.